Hello everyone and welcome back to the next lecture of our blockchains course. We've been discussing use cases in the financial services industry, and today we are going to specifically look at two aspects of financial services, compliance and mortgage. These are both very important aspects of financial services today, and we'll look at how blockchain can make a difference to both of these use cases. So financial services, one important aspect of it is compliance. So today there is a process called KYC, Know Your Customer process. So if you have ever opened a bank account or if you have got a postpaid connection with a telecom company, you would have gone through this KYC process. So what is this? So this process is a regulatory requirement. It's a mandatory requirement for many aspects of our daily industrial work. So working with banks or working with telcos, there are many places where KYC is applied. And why do we have this? So it's a regulatory requirement to ensure that we have a good knowledge of every organization has a good knowledge of its customers, and it can help use that information to help prevent fraud or money laundering or things of those sorts. What does that know your customer itself? What is the process? The process really is about collecting personal information. So this could be information about your identity. So when were you born? What is your address? Where do you live? Where do you work? Maybe whether if you're a student, maybe those details. Of course, age and all of those aspects. And apart from that, they might collect other aspects. What is your financial standing, for instance? If you're opening a bank account, and all these processes are there are guidelines that let's say the regulatory authority will provide to the banks, and the banks have to come up with the process of collecting this information whenever they are opening an account. And this process is slightly different based on the type of account you're opening. If you're opening a savings account versus you're opening let's say a mutual funds account, or you're opening a stock trading account, all of these may have slightly, or a credit card, all of these have slightly different processes, slightly different sets of information that they seek. Right? So from the perspective of the bank, all of this processing is they're doing this purely because the regulator requires them to do this. And they incur a high amount of cost going through this process. Right? And for individuals, more than individuals, for corporates, the process is much more stringent. So as a corporate entity, if I am going to open a bank account, then the process I need to go through is much more stringent. Right? So for the banks, all of this is just pure cost. They're not going to get any revenue, or no one's going to pay them money for going through this process. And in fact, it's actually a bit worse, because if they have a very stringent process, they take too long to implement this, then another bank that might have a very loose process and they have a very streamlined process, customers would go to the bank that has a more streamlined process that does not have so much paperwork to do. Right? So the banks, there's actually an incentive to not do as much in terms of KYC. Right? So both, if they do too much, it's more cost for them, and it's also customers are going to run away. Right? If you're too stringent, if it takes you, let's say, 1 month to go through this process, we'll go to a bank that does it for you in 2 days. Right? So it's also a way they might lose customers because of that. So banks want to do just enough so that they pass the regulatory norms. Now that's from the bank's side point of view. What is it for our end customers like you and me? Today, let's say when I go to SBI and open a bank account, they ask me for, let's say, 10 documents, identity, address proof, and all of those things. I give all of that to them. And SBI has gone through the KYC process, all good, my bank account is opened. Tomorrow, if I want to open a bank account with, let's say, HDFC will ask me for the same set of documents again. I have to give them the same copies. I have to go through the same process all over again. So for me as an end customer, it's a waste of time, it's a waste of effort. And it's a laborious, repeated process for me as well. So everyone in this ecosystem has a problem here. As an end customer, I would like to just do this process once. And if the banks can share this information, then I'm happy. When I go to another bank in this consortium, I don't have to repeat this process again. hopefully, right? Or maybe they only ask for the incremental information that they need. Maybe I've opened a savings account with SBI, they have a bunch of information. When I go and open, let's say, a credit card with HDFC, they should be able to get the information that I've already given to SBI, and maybe they need just 2 other things from me for opening a credit card account. And they should just ask me for that extra information, right? So that way I can reduce the redundancy in the system that exists today, right? And same thing for the banks. For both SBI and HDFC, if HDFC can get documents from SBI where customers have gone to SBI first, and vice versa, if SBI can get documents from HDFC whenever customers go to HDFC first, then the ecosystem can share the information amongst themselves and can reduce the overall redundancy, inefficiency that exists in today's world, right? So that's the whole KYC process. And once the KYC process is done, there is a lot of processes that happen for AML. AML is anti-money laundering. And again, there's a whole lot of due diligence that is done for every transaction that you perform. There is actually an anti-money laundering set of processes that happen to make sure you're not doing something suspicious or fraudulent, right? This is what I mentioned here, right? So what are some of the pain points today? Know your customer process. There is a lot of duplication for both the banks and for the end customers. We would like to remove that. And today, basically, it's a multiplicative factor, right? If I have to open accounts with 10 banks, and each of them require 10 documents, then I'm repeating this 100 times over, right? So there's a multiplicative factor here. And today, the estimate is banks spend somewhere between 60 million and 500 million annually in going through this KYC process, right? And anywhere between 5 and 100 documents. And like I said, it's a lot more for corporate customers than for individual customers. And this is all because of regulation. We want to prevent fraud. And a lot of banks believe that a change in regulation or legislation is the most influential factor for their KYC process. And these regulations and the policies keep changing almost on a monthly basis. So the regulator will say, I want this addition. Like for instance, we're all going through this Aadhaar process today. The regulator says you have to link your Aadhaar with your bank account, right? That is debated still, but let's say the regulator has said you have to link your Aadhaar with your bank account. Then all the banks have to go through this process, all the individuals have to go through this process, and they have to make sure they're compliant. And these regulations change on a daily basis. So, and there is a cost of non-compliance as well. If the regulator finds that this particular bank is not following norms, they will penalize them, and sometimes that penalization can be in multiple millions of dollars, right? And there have been many such cases worldwide. And a lot of the times people also believe that it's a distraction because even the individual information is changing regularly. Maybe I change my address, I change my phone number. The regulatory process requires that the onus is on the banks to make sure the records are up to date. So if I change my address within 3 months, the onus is on the banks to make sure the updated address is in there. So all this becomes a distraction from them from the regular banking business. So that is also a problem. So for instance, some of the numbers we have right here. Today, to onboard a new corporate client, on average, it takes about 24 days. Right? That's a huge amount of money in huge amount of time and money in today's world. And the cost is 22% higher now than 12 months before. So this cost is also growing with time. And the banks are not getting any benefit for this, right? They're just being compliant. So how can we address this with blockchain? And this is again a big differentiator that blockchain can bring in, where we have a shared KYC solution. So think of a consortium of banks that have come together. They're all agreeing to share this information with each other. So between, let's say, SBI and HDFC, they have an agreement to come to a network together. Any customer that goes to SBI first and then to HDFC, HDFC can get the documents from SBI. And if the other way is true, if I go to HDFC first and then to SBI, SBI can get the documents from HDFC. And think of it as a larger network. Maybe a group of 20 banks can come together, agree to share. Now I have to do the work only once. all 20 banks can benefit regardless of where I go and open my account next. Right? And it also helps in keeping the information up to date. Let's say today I open an account with SBI, I gave a set of information. Tomorrow I go to HDFC, maybe not tomorrow, maybe let's say after 6 months I go to HDFC. When I go to HDFC, I give them updated information, maybe a new phone number, a new address. When HDFC gets that new information, they can share that back with SBI. SBI does not have to reach out to me again to get that updated information. So all that will result in savings and benefits. And that way we can significantly reduce redundancy. We can improve the efficiency of the overall process. And we also improve standardization. So all these banks now can follow the same process. And this process can be vetted by the regulator because it's on blockchain. It's all automated on blockchain. The regulator can also see that yes, this process follows the guidelines I've specified today. Tomorrow if the policy changes, you can also modify the process to be adherent, to adhere to the policy, and that can also be done. So it also improves standardization. It's not like 20 different banks are going to ask you for 20 different documents, right, when you go on. They're all going to follow the same process. So that's also a significant benefit. So again, I went through some of these. So the key participants in the network is, of course, the set of banks. Customers could have identity on this network to say that these are my documents, and we can have a notion of consent. So let's say I have given my documents to SBI. When I go to open my account with HDFC, I can give them my digital consent, a signed transaction on blockchain to say, I am permitting HDFC to get the documents from SBI. So that is a consent transaction that the customer might provide, and only after consent is provided will HDFC be permitted to view those documents. So I talked about the banks and customers. Government can be a regulator, an auditor on this network. They can have immediate oversight. And there could be optional service providers on top. So there could be third-party service providers who provide KYC as a service. That is also possible. So there are significant benefits that I have talked about. So we can go from periodic monitoring to almost real-time monitoring. So today it is all very ad hoc on how updates are made to my KYC record. Unless I go and tell my bank my address has changed, it's very hard for the bank to know. And you will also notice if you have a e-banking and net banking account, after every 3 months or 6 months, they might pop up a question saying, are your details still the same, right? So those sorts of things can be avoided if this information is getting shared, and they can continuously monitor how information is changing. So just going through this quickly, what are some of the information that is getting shared? Of course, there is a set of documents that are getting collected, and apart from the documents, there is a customer due diligence process, and that process can also be standardized and shared across all the banks, all the participating banks. Blockchain could store either the documents themselves, or more ideally, because this has personal information, and you probably want to store just the hash of those documents on blockchain. You can verify that hash saying when SBI shared those documents with HDFC, HDFC can actually verify that these documents have not been tampered with because the hash is still the same. What documents I got from SBI are really what were put into the system 3 months back. Right? So you have that proof of authenticity, of integrity of the data. So what are some of the documents that are getting stored? What's some of the information that's getting stored on the network? We have proof of identity and address, and there could be other notions of identity that we are storing there, like employment and so on. There is also aggregated transaction behavior, and this is part of the customer due diligence process that every bank actually implements today. So based on how the pattern of transactions that I am performing, they will compare that with some of my peers and say, is that transaction pattern similar to what they would expect of one of my peers? If the transaction pattern is somehow deviant or anomalous from what other people are doing, they might actually flag that off for manual verification. And that might actually be a trigger for tracking maybe money laundering or fraudulent transactions. And the other kind of information that's also getting stored is credit score. So it's also possible for all of these banks to share information to mutually agree on risk assessment. So today, risk assessment is being done in silos. Each bank, or even within a bank, multiple lines of businesses. Let's say the credit side of things, whereas the personal account or savings account may not talk to the credit card account line of business of the bank, right? They might not even be sharing risk assessment information. So all of that can now be in some privacy preserving manner. We can bring that onto a blockchain platform, and that can help credit scoring as well, credit scoring and risk assessment for individuals and corporates. So this is a high-level model of how this might work. So there is a client, a service provider. Think of it as a bank. So this is, let's say, the first bank that onboards this client, and there is a requester. This might be a second bank that the client has gone to, and there is a regulator that's overseeing all of this. So there is a document share model, that is the inner circle. So this is where documents are being shared by the entities in the ecosystem. Let's say a client first comes in. So they are going to give a set of documents or submit a set of documents to a particular service provider. They can also revoke access at some point. Maybe I'm closing my account with SBI, and then I say SBI should no longer have access to my records, my customer records. So that is give and revoke access. So the client now is in charge of their own data, the documents that I have provided. So we can bring that in. So this is the customer consent. So that's the consent model, that's the outer circle. Now the service provider can request for access, saying this particular client has come to my bank and has requested it to open this kind of an account. Maybe it's a credit card account. And because of that credit card account, I have a request to see these documents that the client has submitted. And it's possible for you to anonymously share these documents across banks. And then each service provider that the client goes to can get access to these documents. Likewise, a third service provider can also come in and request these documents. And then once a client provides consent, the documents can be shared with the other service provider. Regulator at any point of time can come in and verify whether all of this sharing is being done in a regulated manner, whether the due diligence is being performed when collecting these documents, when sharing these documents with other banks. So all of that regulatory oversight is then possible. Okay, so with that, we've covered the KYC process itself. So let's look at the next use case, which is the mortgage process. So this is again another major use case for financial services. Again, there are many aspects of mortgage itself. I'm going to give you just a high-level overview of what this is and what are some of the benefits in mortgage for bringing in blockchain to support mortgage processes. Today, again, the whole mortgage system is extremely manual. There are a lot of physical steps. If you've opened, let's say, if you've bought a house on a loan, you will know. I've bought one. It probably takes you 2 months to get a loan approved, right? And there are a lot of documents that they ask for, a lot of regulatory processes that the banks internally go through before they approve a loan. And in today's world, you probably also know there are a lot of loan-related fraud that has happened, and a lot of that is coming out in recent times. And a lot of it is because, and there are lawsuits, right? The regulators say the banks or whoever provided the loans have not followed due processes, right? A lot of that is because we are following very manual processes. It's very inefficient today, and very little a regulator can do because it's so complex, and oversight on each and every loan that is being provided is very hard. So some of these frauds surface very late in the day also, right? After several years even. So what are some of the mortgage processes? So first, to begin with, there is a mortgage origination. So this is where there are originators. These might be employees of a bank, could be others, third-party service providers, who work with homeowners or people who have bought a home to generate mortgage loans. So they will assess value of these homes. So there'll be like appraisers. There might be companies that will look into the title deeds to see whether this title is a valid title, or is it fraudulent? Are you the real owner of that house, and so on? And there are a lot of these checks and balances that are done in the mortgage origination. And today, like I said, it could take anywhere between 30 and 90 days for you to even figure out whether a mortgage can be applied for this property. So it's very time and paper intensive, too much back and forth between multiple parties here, between the lender, which is a bank or a financial institution, and the homeowner, right? And it could also be multiple employees of the bank that have to communicate, or multiple functions in the bank that are communicating with the homeowner, right? And it's not at all streamlined. There's no standardization, and sometimes even the bank struggle, and very last moment they'll say, okay, I need this document also. You would have given them 10 other documents. They wouldn't have told you that they needed this 11th document also. And then you'll have to run around to get that 11th document. So all those problems exist today because of lack of standardization and streamlining of processes. The second part of it, once you've determined that this is okay to give a loan, you've appraised the value of the home, and you've determined that this is how much loan I can give, then there is a loan servicing part of it. So the loan servicing part is where the institution, the serving institution or the financial institution that has lent the money, is going to collect payments on the loan. Maybe today it could be EMIs that you pay, monthly payments, or it could be lump sum payments that you pay back. So there are many models that are there. Different countries follow different models. And it's also possible to renegotiate a loan. And the loan interest rates also change with time, right? So all of those are part of loan servicing. These are again very little standardization. Different banks follow different interest rates, different processes of how you can initiate, let's say, a renegotiation and so on. Different documents are required. Sometimes documents are misplaced. The banks will ask for you the documents again. They're almost always physically held, right? So today, if you go to a mortgage section of a bank, they will have stockpiles of paper of all the loans that they have today, and very disparate IT systems that are not really connected with each other. There are a lot of issues with loan servicing themselves, and this is even more problematic. I'll talk about that when multiple banks are involved in giving a loan. So we'll talk about that. Then the third part of it is mortgage securitization. So what happens is a mortgage can also be sold to third parties. There might be an initial lender, let's say a bank. That bank might sell one mortgage, or they might aggregate multiple mortgages together, securitize it, and sell that as a security. That security might actually have 100 mortgages underneath. And these are a large fraction of these, at least in the US, they are sold to government-sponsored entities. And there are again some regulations here. But one of these problems is, I think if you go back to the 2008 financial crisis, a lot of that happened because of mortgage securitization and the lack of transparency there. So what happened is mortgages were pooled together, and the risk assessment, they went through almost like multiple levels of securitization. So mortgages will be pooled into a security. Those will all be pulled together to another level and another level and so on. By the time you go to the fourth or fifth level, you have no visibility into the original mortgages themselves or the risk associated with those mortgages. So there were a lot of these really bad mortgages that were created, but at the fourth or fifth level, they'll be packaged as a AAA rated security and so on, right? So those sorts of problems arise because there's very little transparency across the board. And multiple parties were also involved along the way. So the whole 2008 financial crisis was attributed to that. Again, multiple pain points there because of that. So this is just an example origination process. Multiple parties that are involved: a lender, a buyer, borrower, and a seller. So think of it as let's say I'm a buyer, I'm going to buy it from another person who owns that property currently, and there's a bank that's involved. There might be third-party service providers who act as appraisers to see whether the value of the house, whether it could be associated with a housing authority, because it might be one flat out of one apartment in a larger complex. In which case, I have to validate whether the housing authority or the complex itself is a legal entity, that land is okay, and then I have to validate whether that flat has legitimate documents. There are multiple aspects of it. And then there is a notary office, a registrar, and so on that you have to work with. Again, a long process. I'm not going to go into the details of the process itself. So it's useful to think of this in two ways. One is the exact existing origination process. You can bring that onto a blockchain system, and you can bring all of these parties onto a blockchain system, and you can bring in automation and efficiencies. But a more transformative way of looking at it would be to say, I'm going to completely rethink the way this thing works, because this is so paper-oriented, so manual in nature today. I'm going to envision a completely new way of doing mortgage origination. And that new process, a set of financial institutions can agree to bring that on board, and a set of service providers together with, let's say, the land authority or notary office can all together come together to come up with a new process in which they're going to do mortgage origination. And some of those conversations are happening today. And that can significantly improve transparency, can improve efficiency, automation, and so on. Right? And the bottom are some of the documents that are needed for this kind of a origination process. So a next level of complication, these are more broadly not just mortgage, which is tied to land and housing, syndicated loans. So syndicated loans are loans where one organization or one entity is asking for a really large loan, maybe for building their business, and multiple, it's beyond the risk that a single bank is willing to take. So there might be a consortium of banks that come together, sometimes upwards of 10 banks come together to provide portions of the loan, right? And so each bank might take on a different amount of risk. So maybe the whole loan may be for 1,000 crores. Each bank might take 100 crores and agree to give 100 crores to the borrower. Now, again, there is a huge process of how this works, right? So there could be multiple participating banks, a borrower. There could be an arranger or an agent that actually brings these banks together for this borrower. There is a book runner who keeps tab of who has lent how much has been repaid, and so on. There could also be investment banks. There could be a secondary market on this, right? So beyond just the primary market of providing the loans, these banks might sell those loans to other investments, right? They could securitize it and sell it. So that becomes a secondary market and set of investors there. So there is a whole set of an ecosystem here of participants. There are a set of benefits for each of these participants to actually come onto a blockchain network because it improves transparency for them. They know how much has been borrowed by this entity. It's today what has happened is there might be one syndicate of banks providing a loan to a borrower. That syndicate might be completely unaware of another syndicate of financial institutions that have also provided loan to the same borrower, right? And that means that their risk calculations were completely out of whack, and that has led to a lot of these non-performing assets today, in India especially, and that's true for a lot of the developing countries as well. Again, there are a lot of direct and indirect benefits that blockchain can bring about for syndicated loans. So hopefully I've motivated why blockchain can significantly change the landscape of how we do compliance and mortgage today. So if you've not seen, if you don't know what the Know Your Customer process is about, I would encourage you to look up the Wikipedia article. It gives you a good set of details. And this is a nice Reddit article, I think back in 2010, that talks about why KYC is mandatory now. It's a very short article. It just tells you why it's mandatory, why it's useful for banks to follow this. And again, for syndicated loans is a nice Wikipedia article that tells you what syndicated loans are. With that, thank you. And in the next session, we'll look at some more aspects of financial services where blockchain can play a differentiating role. Thank you.